Well, let's stick with the Fed. As we were discussing, the big question of the week is the Fed rate cut that everyone is expecting, and then the question of how much. Joining us from Pasadena, California to discuss, Whittier Trust CIO Sandip Bhagat. Sandip, thanks for coming on. Give us your take, what you expect to see this week.
Chairman Powell indicated a bias and a tilt towards easing several weeks ago. So a rate cut is already in the works. Now, this is not because the U.S. is weakening to the point where the beginning of an easing cycle is justified. In fact, it's quite the opposite. The U.S. economy is quite healthy. It's just that the rest of the world is not, and global trade tensions still persist. And so, yes, the Fed will cut rates this week. No, it's not likely to be the 50 basis points that many people are expecting. The Fed will go ahead and implement what you can think of as an insurance cut of 25 basis points. This is their preemptive strike against the likelihood of a recession. It is to safeguard against the possibility that the global economy continues to weaken more, global trade tensions could yet still escalate, and that somehow the U.S. becomes vulnerable to these types of downside risks.
Hey, Sandip, so on that point, I mean, it seems like everyone's kind of on the consensus that at least we'll get some sort of rate cut in the meeting on Wednesday. But what after that? Does that start an easing cycle? Do you watch the future FOMC meetings through the rest of this year for more rate cuts? Or do you think this is the insurance cut that they can land one time and then basically stall through 2020?
Well, it's been a really difficult path for the Fed, right? They just have struggled to reconcile to this really unique divergence in global growth. Global growth across the world has been quite bifurcated. The U.S., as we mentioned, is quite healthy. The rest of the world is not. And the global trade war has persisted for longer than many had expected. So this protracted nature of the global trade war now makes the foreign economies even more vulnerable, where trade is a much bigger part of their economy. So here's the dilemma. How do you tackle this dichotomy? Do you focus on domestic fundamentals that are strong, or do you pay heed to events outside the U.S.? It seems prudent, perhaps, to base monetary policy on domestic growth fundamentals, which is exactly why the Fed raised for a fourth time in 2018. It took longer to move to the sidelines with a patient approach in early 2019. And it's only this week that they will ease, even though the markets have been clamoring for more for several weeks at this point already. So what lies ahead? Look, the market is expecting 3 rate cuts by the end of December. Now, it's remarkable and a bit mysterious how they latched on to a promise by Chairman Powell that they will act as appropriate to sustain the economy. So how do you go from this vague, diffuse promise to a very clear path with a clear timeline of 3 rate cuts? I think the market may be overly aggressive and optimistic on this front. I see the rate cut this week and maybe one more 3 to 6 months out.
Well, Sandip, that actually, I think you kind of answered my question. I was going to ask you whether or not, on the point of overly aggressive, where do you stand on this sort of debate on whether or not these cuts should be taking place at the times that they're projected?
I think it's okay. I think the Fed has it right. You can't conduct monetary policy on a whim, on a dime, on speculative, low probability events. We know how the fortunes on the trade front can trade as quickly as a mere tweet, right? So the markets have the luxury of pricing bond yields on a tick-by-tick basis as they reassess different probabilities and different outcomes. I don't think you want the Fed or any central bank to react in a similarly haphazard, erratic, and quick manner. So I think the Fed has handled this just right. For those who accuse them of being too slow, being overly aggressive, well, what price have we paid for that alleged error? The U.S. economy is doing fine. We're averaging 170,000 jobs per month. So caution is appropriate.
Sandip, I know we're so focused on the Fed, but while we have you, can I get your take on the recent earnings frenzy? We've had so many big tech earnings, and of course Amazon with a rare miss on earnings, saying that it's going to be investing more, spending a lot to go to one-day shipping. What do you make of some of the big companies we've seen report, and then soon we're going to get Apple earnings always in focus?
Yeah, 1/3 of U.S. companies will report this week. So we're right in the thick of earnings season, which so far seems to have gone well. So 77% of companies that have reported have exceeded earnings expectations. 61 have exceeded revenue expectations. The earnings growth that was projected for this quarter at the beginning of the quarter is now slightly better. The forecast was for a decline of minus 2.7%. That estimate stands at minus 2.6, which just seems like a marginal improvement. But keep in mind, this the measured number for the second quarter took a big hit when Boeing announced that excessive charge. We reckon that it knocked off a full percentage point of S&P 500 earnings. So there is a clear trend that earnings tend to improve as reports come in, as the quarter unfolds. Even if we end with a negative earnings quarter in terms of growth rates, it will indeed be the second one that has small, modest declines. That technically qualifies to be an earnings recession. But quite frankly, that whole topic is absolutely moot, right? The job of the stock market is to discount events in the future, and it has managed to go up even as this earnings recession, a very mild one, is about to unfold. This earnings recession of 2019 was a cause for concern for the markets. Back in 2018, the fact that it has gone up this year means it is willing to look through this and to a potential recovery in the second half of the year.
Right. As our colleague Miles likes to say, we are in a market that wants to go up. That is the character of this market. Sandip of Whittier Trust, thanks so much for joining us.
Great.